Paying $0 in taxes in retirement probably sounds too good to be true. And typically when something sounds too good to be true, it probably is too good to be true. But that's not the case here. And in today's video, I'm going to walk you through a case study where I show you step by step what you can do to pay $0 in taxes on up to $100,000 of income in retirement. And hint, before you think this is some crazy tax loophole, it's not. This is just good planning. And when you start to understand that different types of accounts are subject to different tax rates, you can be very strategic about where you pull income from to stay under certain thresholds and possibly even pay nothing in taxes if you do things right. Let's jump right in so I can show you how you too can do something like this with your own financial plan. Now what we're going to do is we're going to walk through how to create $100,000 of income but not pay any federal income taxes on it. I'm going to ignore state taxes for the purpose of this example because all 50 states could be different here, but just looking at federal income taxes. So if you are working, let's assume that we have Joe and Sally. Joe and Sally are both working, they're both over the age of 65, and they're working earning $100,000. If they were to do that, they would be paying well over $15,000 in taxes. About half of this would be in the form of federal income taxes, and the other half would come from what are called FICA taxes or payroll taxes. These are the taxes that you pay to fund Social Security and Medicare. Not a perfect split, but about 50-50 between the two of those and a total tax of about $15,000. Now let's compare that to what this could look like once Joe and Sally were retired if they had the right strategy to minimize their tax bill. A few key facts to know about Joe and Sally before we get started so that we can pull this information into their projection. Number one is they're both age 67 and they are retired. Number two, they want to live on $100,000 of income throughout retirement. Number three, John is receiving Social Security income of $3,200 per month, and Sally is receiving Social Security income of $2,000 per month. Next thing to know is they have a brokerage account. This brokerage account has $500,000 in it. $250,000 of that is what they put into the account, and the other $250,000 is gains. This is very important for part of what we're going to show in a bit here. This brokerage account has a 2% dividend yield, so the $500,000 that they have is generating $10,000 per year in dividends. And then finally, they have $650,000 in combined traditional IRAs and $150,000 combined in Roth IRAs. So that's Joe and Sally. Retired, about $1.3 million in their investment portfolio, Social Security coming in, saying how do we keep our taxes as low as possible, knowing that we want to generate $100,000 per year in income. So instead of me talking through how they would do this, let me actually show you. Here's a software that we're using to model this out for Joe and for Sally. To start, we want to start with what do they already have? Meaning before we start pulling money from accounts, before we start deciding where to bring income from, what income is already coming in? Which to start is Social Security and dividends. Whether or not they decide to do anything else, that's already income that's coming in that's going to be taxable to them. So let's start by projecting that out. So the Social Security benefit that they have, a combined $5,200 per month, that comes out to $62,400 per year. As you can see, I've already plugged that in. That's an amount of income that they're not necessarily taking on a discretionary basis. It's just coming every single month, every single year. If we were to run a tax report, as if Social Security was the only thing Joe and Sally had coming in, one of the interesting things to note is this. Here is that total Social Security amount that they're receiving, the $62,400. But the thing to note is the amount that they're paying taxes on, the taxable Social Security, is zero. That has to do with something called provisional income. Provisional income determines how much of your Social Security benefit is included or is taxable and how much is tax-free. I made this video right here if you want to see exactly how Social Security is taxed, so we're not going to go through that today, but just know there's a difference between the amount of Social Security that you're receiving and the actual taxable Social Security. So far, Joe and Sally only have $62,400 of income, not yet the $100,000 that they want, but so far they're also at $0. $0 of their Social Security benefit is taxable, they have their deduction, and their total tax is zero. Just to give you a sneak peek of what we're going to try to be doing here is we want to see how can we use up this deduction. So far, they have $0 in income. Yes, they have Social Security, but none of that income is actually taxable. So this deduction actually isn't doing them any good so far because it's a deduction against nothing. They're already in a 0% tax bracket. So let's go back to this. What we've done so far is we factored in the Social Security of $62,400, and we say they don't owe any taxes if that was their only income source. That's not their only income source, and they're not yet where they want to be in terms of their total income. So the next thing that we want to do here is we want to plug in how much they're going to receive in dividends. They are receiving $10,000 per year in qualified dividends from the brokerage account that they have. That brokerage account is $500,000, yielding 2% per year in dividend yield. That's $10,000 right here. Let's go back to that tax report to see what's changed. What we can see right off the bat is something has changed. Their Social Security benefit, the total has not changed. That's still $62,400, but taxable Social Security is now different. Previously, this was $0. Now it's $4,600. Because their provisional income has increased, more of their Social Security benefit is now taxable, $4,600 to be exact. When you add that $4,600 to the $10,000 of qualified dividends, their total income is now $14,600. So you can start to see what's going on here is as other income from other places is increasing, it's pulling some of that Social Security benefit into the tax equation as well. The good news is their standard deduction, the $33,200, this is still enough to fully offset the total income, the total adjusted gross income that Joe and Sally see here. But we're not yet at the $100,000 of income that they want to be living on. One other really important thing to note here, of this $14,600, $4,600 of it is going to be treated or taxed at ordinary income rates. Ordinary income rates are these federal income tax brackets here, 10%, 12%, 22, 24. But the other $10,000 here, the $10,000 from a qualified dividend, that is subject to long-term capital gains rates. Long-term capital gains rates are taxed at either 0, 15, or 20%, and you can see those right here. So I'm going to come back to this in a second because this plays a key factor in our ability to keep taxes under certain thresholds, but I just wanted to give you a little bit of a teaser as to what we're going to be looking at in just a minute here. So back to Joe and Sally and their goal of trying to pay $0 in taxes on $100,000 of income in retirement. So far, they are at $72,400 of income between Social Security and the dividend income coming in. What we can see here, and as I just pointed out, they still have some standard deduction left over. So you might look at this and say, okay, well, the difference between these two numbers is $18,600. So James, shouldn't we take the next $18,600 from their traditional IRA? Because in doing that, you would think that that brings their adjusted gross income up to exactly $33,200, which is then fully offset by their standard deduction here. While that appears right, it's actually wrong. And it's wrong because of this right here. Remember the relationship between provisional income and how much of your Social Security income is going to be taxable. If we were to pull the full $18,600 from their traditional IRAs, that at first gets us to this goal. It says, how do we match our adjusted gross income to our standard deduction? So that cancels out, that washes out, until we realize that pulling that from the IRA is simultaneously pulling more Social Security benefits, Social Security income, into the taxable income equation. So that isn't the right thing to do in this case, because if we did that, it would actually cause their adjusted gross income to exceed their standard deduction. Now, in the grand scheme of things, maybe not the worst thing in the world because they're still in a very low tax bracket, but what we're trying to show here is how to be in a 0% tax bracket. So that's not going to work for this example that we're looking at. So instead of doing that, let's pull out exactly $11,600 from their traditional IRAs. And what that's going to do is when we add that to their dividends and we add that to their Social Security, now they're at $84,000 of total income coming in. To see the impact of that, let's go ahead and plug this in. So what I've done is I've taken this and I put in $11,600 to say that's their total IRA distribution here. So again, we have $10,000 in qualified dividends, $11,600 in IRA distributions, and still that same Social Security amount, gross Social Security amount of $62,400. Let's go ahead and run that tax report and see what we see. So here that is, and the first thing I'm going to point out is exactly what we left off on last time, of the more they pull out from other sources, in this case their traditional IRAs, the more of their Social Security benefit is being pulled in to their income that they're paying taxes on. So in this case now $13,480 of their total Social Security benefit is included in this number right in here, is included in their total income. Now here's where things get interesting. Of their total income, it now exceeds their deduction. So at first glance, you might say, okay, James, well, we missed it. If the goal is to pay $0 in taxes on our income, we're not going to do that if our adjusted gross income exceeds the standard deduction. Because look, now we have $1,880 of taxable income. Well, that is correct, but not all taxable income is created equal. Now pay very close attention to what I'm about to say here. Yes, they have taxable income of $1,880. But taxable income can be taxed either ordinary income rates, which are these rates here, or they can be taxed as long-term capital gain rates, which are these rates here. Long-term capital gain rates, until you have $96,700 of taxable income or more, these numbers are married, filing jointly for 2025, you are in a 0% long-term capital gain tax bracket. Now, some of you are thinking, James, how on earth are you pulling money out of a traditional IRA and having that taxed at long-term capital gains rates? Good question, and the answer is I'm not. What's happening is when you go back up here, this total income, keep in mind, some of this is actual ordinary income. This is ordinary income, the portion of Social Security that's taxable, and the IRA distribution is ordinary income. But 10,000 of this is a long-term capital gain. So this number that you're seeing here is a combination of those. This deduction is going to offset that ordinary income first here. So the ordinary income portion of this is $25,080 because 10,000 of it is a qualified dividend, which is taxed at long-term capital gains rates. So the ordinary income is offset first by the standard deduction, and the remainder is long-term capital gains, some of which is offset by the deduction, but the remaining amount, the $1,880, is not. So to go back to what I was saying, yes, the IRA distribution increased this and pushed things over the standard deduction threshold, but the amount that got pushed over is those qualified dividends because that IRA distribution, that's being offset by the standard deduction, whereas the overflow or the excess here, this $1,880, this is all going to be taxed at long-term capital gains because it's really that qualified dividend that exceeded it here. What's a little confusing here is I'm stacking Social Security, then qualified dividend, then IRA, and then the next thing, which we'll show in just a second, but that's not the way the IRS treats it. The IRS doesn't care what you're factoring in first. They're going to offset the ordinary income, the IRA distribution, and the taxable Social Security using that standard deduction before offsetting the qualified dividend or any long-term capital gains. Now, on that note of looking at long-term capital gains, look at this amazing opportunity right here. So far, Joe and Sally have taxable income of $1,880. They don't pay any taxes on long-term capital gains until that number exceeds $96,700. Or in other words, there's a significant amount of long-term gains they can realize before they actually pay any federal taxes on those gains. Keep in mind, as I said, the more they realize in long-term capital gains, the more their Social Security income will be taxable. But this is where it's really important to understand the relationship between all these different types of taxation and the way that the IRS is calculating what types of taxes you owe on different sources of income. But where we're going next, well, if we go back to Joe and Sally, we're at $84,000 of total income at this point. We need to find $16,000 more to bring them to $100,000, and we've identified that there's a pretty significant gap here between how much taxable income they have and how much they can realize before they start paying taxes on that income. So let's go back here. So far, we have not realized anything in actual long-term gains. They have qualified dividends, which are taxed at long-term capital gains rates, but they're not actually long-term gains themselves. When we go back to Joe and Sally's portfolio, they have $500,000 in a brokerage account, of which $250,000 is basis, meaning they've already paid taxes and they put that money in. The remaining $250,000 is long-term gains. So to make the math simple, if they need $16,000 more, that means they're going to sell $16,000 worth of stock, and that's going to free up the income that they can use to supplement Social Security, dividends, and IRA distributions to get to that total $100,000. But selling $16,000 of stock doesn't generate $16,000 of long-term capital gains. It generates $8,000 of long-term capital gains. That's because of that $16,000, $8,000 they've already paid taxes on as basis. The remaining $8,000 they have not. So let's plug that in. Selling that stock generated $18,000 in long-term capital gains, and now let's see what this tax report looks like. So once again, let's go through the progression here. Let's start with their Social Security. Here's their total benefit. Now a little over $20,000 is included as taxable Social Security. That's going right to this number here. So we have $20,280 of taxable Social Security. We have $10,000 of dividends, qualified dividends. We have $11,600 of IRA distributions, and we have $8,000 of long-term capital gains, which came from the sale of $16,000 worth of stock. So that total adjusted gross income is now just under $50,000. The deduction is $33,200. So once again, as we talked about before, they've exceeded their deduction, but because we understand the nuances and the difference of how IRAs are taxed versus long-term capital gains versus qualified dividends versus Social Security, we know that that $16,680 isn't actually taxable. And the reason for that, again, is because this deduction, first and foremost, is offsetting the IRA distribution they took, as well as the taxable Social Security. The difference, the excess here, that's qualified dividends and long-term capital gains. So if we look at their ordinary income tax rates, They don't have any taxable ordinary income because it's fully offset by their standard deduction. When we scroll down to their long-term capital gains brackets, they do have taxable income subject to long-term capital gains taxes, but they're still in that 0% federal long-term capital gain tax bracket. So even though there's $16,680 here, they could realize a whole lot more until they actually paid $1 in long-term capital gains taxes here. But once again, the risk of being redundant, every extra dollar they realize there over a certain threshold starts pulling in more and more of their Social Security income to what they pay taxes on, which in this case would have the unintended consequence of increasing their ordinary income, their taxable ordinary income, while they're trying to fill up their long-term capital gain 0% tax bracket. So in summary, as we start to wrap up this specific projection for Joe and Sally, they just created $100,000 of income, made up of $62,400 from Social Security, $10,000 from qualified dividends, $11,600 from IRA distributions, $16,000 of sales from stock that was half long-term gains and half return to basis, $100,000 of income, $0 in taxes. Now, when we actually look at people's real situations, it's not actually always the goal to pay $0 in taxes this year. The bigger priority is to understand what will your taxable income landscape be over the course of your retirement? What will your lifetime tax liability be? And then how can we strategically pay the right amount in taxes this year and following years to minimize your overall tax liability over the course of your retirement? But if you want to pay $0 in taxes in retirement, it is doable using the principles we just talked about. The better approach is to understand how you can minimize 20, 30 plus years of taxes in retirement when you use the right strategies. Now, as you're watching this, some of you may be thinking, you're making mistakes when it comes to the way that you're planning and you're taking income in retirement. I made this other video right here that highlights other things, other big mistakes I see far too many retirees making, so you can understand what those mistakes are and make sure that you're avoiding them in your situation. Root Financial has not provided any compensation for and does not influence the content of any testimonials and endorsements shown. Any testimonials and endorsements shown have been invited, have been shared with each individual's permission, and are not necessarily representative of the experience of other clients. To our knowledge, no other conflicts of interest exist regarding these testimonials and endorsements. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.